Good afternoon and welcome to our weekly livestock recap. I'm news anchor and reporter Meghan Grebner with Brownfield. With us again is University of Missouri Scott Brown. Good afternoon, Scott.
Good afternoon, Megan.
We previewed last week and said one of the big things that are coming out this week that we'll need to talk about is the WASDE report, and it did. So let's take a quick overview of that and talk about what this means for livestock producers.
Yeah, so I think there's really a couple pieces of news that came out of WASDE, one of which confirms what we expect, which is more meat supplies, and the other on the crop side, a little more of a surprise in terms of some higher feed costs. But starting with livestock markets for a minute, USDA now tells us for 2016, beef, pork, chicken, and turkey production would be up nearly 3 billion pounds relative to 2015, and you look ahead at their first guess for 2017, and another 2.8 billion pound increase in meat production. So more meat supplies coming is still that story that we need to be paying attention to longer term. Yes, we'll get some trade back. Net exports up about 1.4 billion pounds this year, and another little less than a billion pounds in 2017. But ultimately, consumers in this country are going to have to consume more meat. 2016, USDA now says up a little over 3 pounds, and 2017 up a little less than 3 pounds per person. So I always sometimes like to end here by saying you look back at 2014, and domestic meat supplies were at a 23-year low. That equated to about 210 pounds per person consumption, and we're now back closer to over 210 pounds per person. So a change relative to a few years ago, and we do need to hit the reset button when we think about what that means for livestock prices. Now, I think the surprise we got out of the markets is just how tight soybean stocks are in the current year. Losing over 100 million bushels of soybean ending stocks relative to where USDA was in April for this current year has sent soybean and maybe more important for livestock producers, soybean meal prices much higher. Corn followed along as well. So I think we're in for tougher margins on the livestock side. I sometimes will say this may be the difference between what's been a modest return to pork producers in the first quarter of 2016 versus what might be a modest negative if we look at the second quarter of 2016.
Let's dig into those feed prices a little bit. We mentioned we've seen soybeans go up a little bit, corn followed suit. We're looking at the Eastern Corn Belt in particular, where I am, and we're not seeing a lot of planting progress. Weather hasn't been conducive to it. As we potentially look at that switch to soybean acres, does that play better into the livestock producers' profitability and margins, or do we still look at South America and the short crop that they have and say it's not going to be enough?
Yeah, so very, very interesting. I will say, I think the short term is it's been what's happening in South America that's gotten us a lot more price strength. Yet when you look at what USDA is telling us for this year and into next, potentially still record crops occurring in this country. And if in fact you're right that as we get through this planting season, especially Eastern Corn Belt, and we plant more soybeans relative to corn, at least where we thought we would be with planting intentions, I see some signs we could still be more bearish in terms of where feed costs go, which is going to be more optimistic for livestock producers. It just reminds us that this crop that we're putting in the ground right now and the acreage choices that we make are very important in terms of what we ultimately get in the bin come fall. And we're a long ways from this crop being made. Weather events are certainly going to be a reason for higher feed prices for livestock producers. But I say another good crop in the bin, and we keep growing ending stocks of many of these crop commodities, I think provides some maybe risk management from higher feed costs than we've seen for a while. The fact we could buffer a drought as severe as 2012 easier with what will be perhaps over 2 billion bushels of corn ending stocks. Those are some of the things that I think are left to play out, but I certainly think this short-term South American issue and the tough harvest conditions we see there have played to some strengths in corn and soybean prices.
Let's talk a little bit about those livestock numbers specifically. As we look at WASDE and we look at the big picture of livestock production, do we need to anticipate maybe a short-term positive and a longer-term continued volatility in that marketplace?
I think when you look at what's been happening, number one, so it's nice to get some positive news this week. I think, Meghan, the last couple of weeks we've been doing this, it's probably been fairly negative from a cattle price perspective. We got a very nice jump in fed cattle prices this week, anywhere $6 to $10, depending on where you are on fed cattle prices in the country. We haven't seen that for a long time. Yet when I think you look at what's been happening on the boxed beef side, yes, we were up a little bit in terms of boxed beef prices this week relative to the previous week, but the margin that packers are dealing with has tightened up considerably. If it's hard to see, I guess, cattle prices moving significantly higher given just the volume of beef that we're going to be bringing to the marketplace. So I do think we got some short-term bounce. I look at things like the Choice Select spread, which has widened some this week. Perhaps we got a little second grilling season demand going on, and perhaps even some of the weaker prices got retailers willing to feature more beef over Memorial Day. And once we get beyond Memorial Day, does that start to slow down as well? So I do worry there is that downside risk left in cattle and hog prices, just given the supply side that we have going.
You mentioned the Memorial Day holiday. Does that give us maybe a little bit hope, a little bit of hope for a little bit of increased consumer demand, because that's the start of the summer?
Yeah, absolutely. I do think there is some reason to be, short-term positive from a meat perspective. Seasonally, this is the time of year where we do get some increases. Some of the negatives we actually have talked about the previous couple of weeks have really been counter-seasonal in some cases. So I sometimes might say, what a good opportunity for producers, livestock producers in particular, to think about whether there's any risk management they want to do longer term. If we can get some futures markets longer term also moving higher, the opportunity to lock in some longer term prices maybe is a good strategy for some of these folks. But I think, again, I will keep saying, don't go back to the previous couple of years and going, we're going to return to those kind of livestock prices anytime soon. A very unique set of events unfolded that got us there, and the marketplace we're in today is one with a lot more meat supplies.
Any other market news and notes to touch on from this week? How did we end up positive for the most part?
Positive for the most part, so hog prices, and I keep saying, we're pretty large on hog runs. Hog prices up another couple bucks. Fed cattle up 6 to 10. Futures markets up, with perhaps the exception of feeder cattle. Those higher feed costs created some concerns there. I will say, we have to continue to watch what we're doing in terms of feedlots and staying current. If you remember in 2015, much of the reason why we talked about lower fed cattle prices in the latter part of 2015 had to do with just how uncurrent we were in feed yards in the latter part of 2015, and brought a lot of heavyweight cattle to the market. We seem to be much more current today than we were last year, but we need to continue that strategy because we got more cattle to deal with. If we start to get behind again like we did last year, then I'm afraid you and I both know what the latter part of 2016 looks like. So, but markets this week have been good. When you look at what we're doing at the wholesale level, yet again, pork cutout virtually unchanged from the previous week. I will say, you look at bellies in particular, belly prices have been relatively strong. We've lost a little of that strength, yet we're still 40% higher on belly prices than we were a year ago at this time. So some pretty substantial strength happening there. It's nice to see boxed beef prices up nearly $6 relative to where we were last week, driven in large part by across the board increases in those components of that choice beef cutout.
When it comes to the belly, everything is better with bacon. I mean, really.
Everything's better with bacon, and we continue to see that. And again, you can continue to talk about consumer demand, making certain that we're putting those meat products in front of consumers that they want. I think we're doing a lot better today than we might have done 10 or 15 years ago, but there's a lot of work that we need to continue to do to make certain that we're putting what consumers want in front of them.
Scott, I want to touch on one quick thing. We've briefly talked about it in previous episodes. We talk about mitigating risk or better managing risk for cow-calf producers. We do a really good job of doing that with our row crops. As we look at long-term volatility in the marketplace, we look at potential drivers and feed costs. What is the best way for cattle producers to sit down and look at their books and figure out a way to either make a profit or break even and keep everything in the black?
Yeah. Well, so I always start by number one, I hope they do sit down in front of the books before they make that decision. Knowing what their production cost is and what they're protecting is the first step, in that process. Being realistic that you're not trying to beat the market every time. I hear a lot of this, well, I paid so much for this futures contract and it ended up costing me money, and so I'm never going to do that again. Understanding the insurance versus, and I sometimes will say program maximization or futures maximization. If we all knew exactly where markets were headed in front of us, and if I knew that, I wouldn't, be doing this with you this afternoon. I would be somewhere where it's pretty nice with a lot of money in my pocket. None of us know exactly where these markets head. Understanding what you need to cover in terms of your bottom line and making the choice of, I want to reduce my risk and buy that insurance, that's something that you should never look back on, even if it ends up something that costs you money. You want to be participating on a regular basis, not trying to time the perfect time to be in the marketplace. And that's a pretty hard pill to swallow sometimes. And I'll say it's really easy when prices are going up to stay in that cash market. I think it's a lot harder for producers when prices are moving lower to decide to implement some of those risk management options, because, hey, probably tomorrow prices may go higher is always, very optimistic when it comes to agriculture, and I see that play out all the time.
Scott, good to see you. We will talk next Friday.
Very good. Thanks a lot, Megan.
Thanks, Scott. I'm Meghan Grebner for Brownfield.